Somebody spent 11,000 hours filming coffee shops. In late 2019, people with cameras sat outside 620 stores in China. They counted every cup that crossed the counter. They picked up 25,000 receipts and they wrote all of it down. Then they compared their own count against what the company was telling its investors. The two numbers were nowhere near. The company was Luckin Coffee. In April 2020, its own directors said the sales had been made up. Around 2.2 billion yuan of sales that never happened. Yuan are Chinese money, call it $300 million. So America's stock market watchdog went in. It can force a company to correct a number and fine it. Luckin paid it $180 million to make the case go away. And the mechanics of it were almost boring. Revenue is the money a company says came in. It is a decision about when a sale counts. Somebody at the company makes it. By the end of this, you will know the 3 ways that decision gets bent and 3 checks you can run tonight. Let's start much smaller, forget companies for a minute. One afternoon in July, a kid sets up a lemonade stand. She takes $40 across the table. That is her revenue, everything that came in before any costs at all. Now her cousin turns up. She is still holding about $60 of lemonade and the street has gone quiet. So she sells him the whole lot for $60. And she tells him he can bring back anything he does not drink.
Write it down, and her revenue for the day is $100. 40 of that is real. The other 60 is sitting in her cousin's fridge, and he can hand it straight back.
Nothing there is a lie, and there is a receipt for every cup. But the number she reports went up by 60 without one extra customer. In September, the cousin brings most of it back. Her September looks terrible now because she already counted September's sales back in July. That is the shape of the whole episode. Every trick coming up is a bigger version of one kid and one cousin. So what would have caught it? The cash tin, $40 of real sales turned into coins you could count. The cousin's 60 turned into a promise instead, and promises do not jingle. So let's write the rule down properly, because from here you should be able to do this yourself. Revenue is the price times how many you sold, counted on the day you hand the thing over. Handing it over is the moment, not the day the money arrives. Those are 2 different days, and the gap is where this episode lives. Do it small first, 50 cents a cup, 80 cups, 50 times 80, $40. Now the cousin, $60 of lemonade handed over, so by the rule it counts. 40 plus 60, $100, that is her top line for the day. You just built a revenue figure out of a price and a count. That is the whole skill. Now look hard at it because this is where the rest of the episode lives. Which part of that sum can she shape? Not the price, the street sets that, not the cups she poured them. It is when the sale counts and how much of the ticket she writes down. The ticket just means the full price the buyer handed over. Hold on to that word. It comes back in about 4 minutes. Now the grown-up version on a real document. A public company is one anyone can buy a piece of. In return, it opens its books to everybody once a year. That is the annual report, free online and the same document the professionals read. Inside is a page of sums. It starts with everything that came in and works down to what was left. Revenue is the first line, which is why people call it the top line. What is left at the very bottom after every cost is the profit. Companies also report every 3 months. 3 months is a quarter, 4 of them make a year, remember that one. Which means the whole thing turns on one question: when does a company get to count a sale? Same rule as the lemonade. It counts once the company has handed over the thing. The money can turn up months later, so cash is a separate story.
This number is genuinely useful. Revenue tells you whether more people are buying long before profit shows anything. A company can lose money for a decade and still be winning, and revenue is where you'd see it first.
That is worth sitting with. Growing sales with no profit can mean a business is being built. Flat sales with a pretty profit usually means it is being squeezed. And that gap is exactly why the number is worth bending. Between the sale and the cash, somebody has to make 3 choices. How much of the ticket counts when it counts, and how hard you push to make it count now. Those are the 3 dials, and we are going to turn each one. Dial 1, how much of the ticket counts. Take Amazon's report for 2025. Total sales about $717 billion. A few lines down, the same report splits that up. The marketplace, everything other people sell through Amazon, brings Amazon $172 billion. Hold those 2 next to each other. 172 out of 717, about $1.04. And that figure is Amazon's cut. Its fees and commissions, the slice it keeps for running the shop. Amazon says so in the report. Its own words are that it is not the seller of record. The goods were never Amazon's to sell. The money shoppers actually handed those sellers is much bigger, and Amazon publishes no total for it anywhere. Counting the whole ticket is called gross. Counting only your cut is called net. Same shop, 2 legal numbers, and they are miles apart. So that is a company sitting still on the dial. Uber shows what happens when one moves it. In its report for 2022, Uber says it is the middleman in most markets. A middleman introduces you to the driver, so it counts its fee. But in Britain, Uber rewrote its contracts. Now it hires the driver and sells you the ride itself. Uber's British revenue that year was $4.2 billion. The year before, the same country was $551 million. A billion is 1,000 million, so those are not close. That is more than 7 times bigger.
Now, nobody paid more for a ride, no driver earned less. Uber changed how it wrote the same trips down, and its top line, that first number, grew by billions. It's all in the filing, which is exactly the point.
And the cleanest example anyone ever filed is Groupon. It sold cheap coupons for restaurants and split the money with the shop. In June 2011, it asked to be sold on the stock market. It showed $713 million of revenue for the year before. The watchdog pushed back on how that was counted. Groupon handed the same year and again as $313 million. Same company, same year, nothing about the coupons changed. The $400 million that vanished was the restaurant's share. Groupon had counted the whole ticket, now it counted its cut. Groupon's own filing says the change had no effect on profit. The business did not move an inch, only the number did. So gross against net, whole ticket against your cut, is the first thing worth checking. Revenue is a decision about when a sale counts and somebody at the company makes it. Dial 2 when it counts. Some companies take your money long before they do any of the work. That money sits on the books as deferred revenue, cash in hand for work still owed, your gym in January before you have been once. And here is the honest bit, they cannot count it as revenue yet. They hand it over month by month and count it month by month. The biggest example anybody can look up is Microsoft. Its report for the year to June 2025 carries about $67 billion of it. Customers have paid, Microsoft still owes them the service, and the report shows the balance draining away as the work gets done. Adobe does the same thing at about $7 billion.
This one I actually like. Deferred revenue, that money taken early, is a promise the company has to keep. It's the one part of the top line that's already banked, and you can see it coming.
Which is why it doubles as a warning light, and the light comes on early. Quality Systems sold software to doctors. In its report for the year to March 2013, the money taken in advance fell about 22%. Revenue that same year was still going up. 1 year later, it fell for the first time. So a falling deferred revenue line is next year's problem, showing up early. Dial 3, how hard you push. Now we dust this number for fingerprints. Legal, then aggressive, but legal, then fraud. Remember the cousin with a fridge full of lemonade. Channel stuffing, pushing more goods at your customers than they asked for, so the sale lands this year. Regulators have a name for it, and their own words are pulling forward revenue from future periods, borrowing sales from next year. The case that wrote the definition is Sunbeam, which made toasters and barbecues. Its customers were wholesalers. A wholesaler buys a mountain of goods and sells it on to the shops. In 1997, days before a quarter closed, Sunbeam sold a pile of barbecue grills to one of them. It wrote $1.5 million of revenue into that quarter for them. The wholesaler could send back whatever it failed to sell, and Sunbeam paid to ship the grills there, to store them, and to ship them home. 6 months later, every single one of those grills came back.
That's the cousin, with 3 more zeros on the end. And it mattered, because Sunbeam told the world its sales had grown 10% that quarter. The regulator later worked out the real figure was 1%.
So it found a second way. It billed customers for goods, then kept the goods in its own warehouses. That has a name too, bill and hold. The sale went on the books, the pallets never moved. And by early 1998, some customers were sitting on 80 weeks of goods. 80 weeks is a year and a half of orders already stacked in somebody else's warehouse. There was nothing left to pull forward. The watchdog found at least $62 million of that year's reported income came out of accounting fraud. Sunbeam had told everyone $189 million. Counted again, the year came in at 93, about half. Al Dunlap, the chief executive, paid $500,000 and was barred from running a public company. Now that is 1997, and you would hope the habit died with it. It carried on. In 2021, America's watchdog fined Under Armour $9 million. Starting in 2015, for 6 quarters running, which is a year and a half, it asked customers to take their orders early. $408 million of orders dragged back out of later quarters. And the charge matters here. Regulators can charge you with lying or with being careless. Under Armour got the careless one. The orders were real and the customers were real. What Under Armour left out of its reports was that it was doing this at all. So channel stuffing, pushing goods out early, can be perfectly legal. It is still borrowing, and the loan always comes due. Which brings us back to the coffee. Luckin went one step past everything you have just heard. It made the sales up from nothing, and the watchdog laid out how. Staff opened customer accounts on their own phone numbers and bought coffee vouchers. Fake company accounts bought vouchers in bulk. From May 2019, shell companies bought coupons and pretended to resell them. A shell company is a name and an address with no business behind it. Now all of that costs real money. The cash going into the tills had to come from somewhere. It was Luckin's own. So Luckin had a second problem. It had to explain where that money had gone. It invented costs, more than $190 million of them. Made up orders for coffee beans, made up delivery invoices, advertising nobody ever ran.
That's the round trip. Luckin's own cash went out of the door as a payment for beans nobody delivered. Then it came back through the till as a coffee nobody drank. Same money twice, and on the income statement it read as growth.
And here is why it was worth doing. A share is one small piece of a company and people buy them. The better the sales look, the more each piece sells for. While the fraud ran, Luckin sold pieces of itself for more than $864 million. Its shares had gone past $50 each. On the 2nd of April 2020, they fell as much as 81% in a single day. The chief executive was fired the following month, and the chairman was pushed out that summer. And by the middle of 2020, the shares were thrown off the NASDAQ, the American market that sold them. The fair ending is that the company still exists, and it turns a profit now. But the 11,000 hours of video got there first. So here are the 3 checks, and each one takes about 4 minutes. 1. Put revenue next to the cash that actually landed in the bank 3 years in a row. That second number has a name, cash from operations. It is on the cash page, and it is the money the business itself brought in. Both come from the same report. Revenue climbing while the cash sits flat is the lemonade stand shape. 2. Find what customers owe the company and watch it against revenue. If the money owed grows faster than sales 2 years running, the sales are being counted long before anybody pays for them. That is the Sunbeam fingerprint, and you can see it from your sofa. 3. Find the paragraph where the company explains how it counts sales and look for the word agent. Agent means it only introduced the buyer and the seller and kept a slice, so its number is the cut, not the whole ticket. A rival counting the whole ticket is not comparable. Cash what is owed and one word in a note, that is the check.
If that was useful, subscribe. It's genuinely what keeps these getting made, and it means the next number gets pulled apart the same way, out of real filings.
Revenue is a decision about when a sale counts and somebody at the company makes it. Numbers don't lie, people make the numbers. So which number should we dust next? Every figure here comes from these companies' own filings and the regulator's own orders for the periods named. This is education, not financial advice.